What I want to do is take a minute here to talk a little bit about kind of a 30,000 foot level of the things we're seeing economically coming into the end of the year, going into next year. So, first of all, the GDP outlook is turning out much better than what we expected, as Dan touched on, and that's because of the resiliency of the household finances and the strong labor market. Inflation, while it's still elevated, continues to move downward. What we heard just this week, in fact, is that the October CPI came in at 3.2%, which is lower than September, lower than prior months. Go all the way back to the peak of last year was 9.1% in June. So a little over a year ago, our inflation rate was skyrocketing.
Ouch.
So they've got a lot of things under control. The Fed is doing its job by trying to curtail that inflation without totally killing the economy. Talking about the Fed, the next point, they're likely at the end or near the end of its hiking cycle. The one thing that we're noting is as this recession has been drawn out, the projection of going into recession, we thought it was going to happen the second half of this year. Now it looks like the first to second quarter of next year, and it's going to be milder than we thought. That tends to make those rates stay higher for a little longer. Another thing too is that recently the increase in the 10-year treasuries, they actually touched 5% here in the last couple of weeks. And when you have a sustained high treasury yield, that's an actual negative from consumer and corporate spending forecast looking forward. And the reason being is that when rates are high, investors tend to take the safety of a high given rate, certain rate, fixed rate, versus the risk of the equity market. So the money has not flown back into the equity markets like we expect. However, we're actually expecting modest GDP growth next year. So the fact that we will expect to see some signs, as Dan talked about earlier, that profit growth projections could be somewhere between 6 to 10%. That is a sign that maybe, we need to be looking at investing in the equity markets before this thing takes off. Another point here is banks are reducing lending. That's part of the slowdown. So not only are rates higher than they've been in the past few years, the banks have restricted and made it more difficult for consumers and businesses to borrow, which tends to slow down business and economic activity because there's not as much borrowing to finance things going on looking forward. The job gains and real wage growth have been creating more of a resilient consumer, which is has been spending this year, keeping us out of that recession. But we're starting to see that tailwind abate a little bit or slow down. So,
well, that was a lot.
Yeah. Well, we condensed a whole bunch of stuff in 2 minutes.